Hello everyone, welcome to the second video of this week. I'm recording this on Thursday evening, my evening, the 3rd of October, and I promised you to do a piece on seasonality, and that's the plan for this video. It'll probably be a little bit shorter than normal, but you can't really go look ahead at seasonality when the month is halfway through. So here we are, start of the month of October. Let's take a look at what seasonality tells us about the coming month. So here's the spreadsheet that I usually use, showing the outperformance for the various sectors over the various months. Obviously the performance for SPY is absolute, and it is the last month of 3 months with 60% odds of outperformance for SPY. It clearly worked in September, good month for SPY. I did not expect that to happen especially because of the expected returns is 60 basis points lower. That did not happen. And the combination of 60% of the time closing higher than you open with a minus 60 basis points average return tells me that when September is a down month, it is a serious down month. And if it's an up month, it's not that strong of an up month. So probably the month of September 2024 goes against all odds in seasonality land. It's what it is. Let's see what we can do for October. Again, the odds are 60% higher for SPY, and the expected return is 1%, up 1% higher. And I don't know, I already, with the chart of SPY and S&P in my head, I already feel it's a difficult one. Let's take a look at the various sectors. So October, the offensive sectors, 50, 55, 45, 40, not the most convincing ones. Maybe the 40% for consumer discretionary is giving us a little bit of a clue for expected weakness in consumer discretionary. That would match with a 0.3 decline or the 0.3 underperformance for October. But mind you, with a 1% gain for SPY, a 30% underperformance for discretionary still means 70 basis points higher for consumer discretionary. We'll take a look at a few charts in a minute, but again, I mean, last month's title was confusing markets. We're still in that phase where market is trying to find a balance, is trying to find a direction. Sometimes, some days you got extremely good metrics, good news, good views, and market goes up, and then all of a sudden something else happens and you got a very weak market, and you can find a lot of arguments why the market should be going down. Starting with the seasonality bit, so October defensive sectors, 55, 55. So here is healthcare expected to be the weaker one with 35%, which means that 65% of the time the market underperformed, and the expected return here is minus 60 basis points. So that is something that might be worth a look, because it's a little bit better than the flip of a coin. And then when we go to the economically sensitive sectors, it's 56. Here's 240s. Those are kind of weak. And then there's the one that stands out, that's technology at 70%. 70% of the time over the last 20 years, technology outperformed the S&P 500 in the month of October. And the expected return is 70 bips over SPY, which means a 1.7% return for the technology sector. We'll have to wait and see how that plays out, but that is a strong seasonal indicator, if you ask me. And then the weaker one in sensitives is industrials with 40% expected underperformance, so 60% underperformance, minus 0.1. That is okay-ish, I would say. But the ones that we probably really need to take a better look at is what's happening in technology and what is happening in healthcare. I think those two are the ones that are flashing the most important or maybe most reliable signals, if you want to call it like that. So let's take a look at those individual sector charts in combination with an RRG and see if we can find something that is meaningful enough to play. Looking at the current positions of the sector tails on the RRG, at the start of the month of October, and I said we're going to look at healthcare and we're going to look at technology. So let me highlight healthcare first. Here's healthcare. It's inside leading, but you see that it has rolled over. So it's now quite rapidly losing relative momentum. I can see that as a weakness. If that continues, we're heading towards the weakening quadrant, and if we start to lose relative strength, we might be bending to the left, entering the lagging quadrant at some stage. It's a bit hard to look into the future, but this is a weekly chart, so the expectation is for this tail to continue its clockwise rotation, which means at least in the near term some more weakness. And that would resonate, that would match with the weak expectation for the healthcare sector going into October. Remember, it was 35% of the time this sector outperformed the S&P 500, which means that 65% of the time it underperformed. And the average return, and I've got the spreadsheet open on my other screen, 60 basis points lower. So that quite matches with this tail. If we look at if we bring in the price chart of XLV, of healthcare, then we see that the break is there, and we're exactly now resting at I call that a double support level, because we've got the horizontal level, which is the old highs that we saw here in July and August. Those were broken, and that old resistance now comes back as support, and we've got the rising support line that connects all the lows since the end of 2023. Given the weak rotation and the weak seasonals, what we need to see for confirmation is a downward break of this double support level, and I'm going to peg that at 150. So XLV trading below 150 probably triggers further declines, and just throwing it out here, support levels around 146, 145. The first ones. I mean, we may even go as low as 137, but I'd like to take it one step at a time, and the next support level I'm watching here is around 145, 146. So the healthcare sector with a 65% rate of underperforming in the month of October and an expected return of minus 60 basis points is a very good candidate for underperforming the S&P going forward. That's for the healthcare sector. Now, if we look at the technology sector, which is the opposite, that's the sector that is expected to do really well, with a 70% of the time outperforming the S&P 500 in the month of October. And let me highlight technology for you right here. Then you can see how that is, it's quite opposite the rotation of the healthcare sector. Healthcare was inside leading and rolling over, losing momentum. Technology inside the lagging quadrant, and has now, for the last week and a half, 2 weeks almost, turned higher and is picking up relative momentum. They both haven't moved on the RS ratio scale, so the relative trend for tech is still down and for healthcare is still up, but there is a momentum move going on that's counter trend, and that could actually bring XLK higher in the month of October. It's not immediately going to bring it back into the leading quadrant, therefore this tail is too far out. I mean, there miracles are possible, but in a relatively normal market, I don't see this moving back into the leading quadrant within a week, or within 3 weeks, the end of the month. So using decent assumptions, I'm going to say, I can see technology picking up in strength, especially in momentum, and doing a short counter trend bounce, bringing technology up and outperforming the S&P 500 for the month of October. And if we look at the numbers here, so the expected, so 70% of the time technology is outperforming and the expected return on average is 70 basis points. So that's a very decent return if you take into account that the expected return for SPY is 1%. That would mean 1.7% for technology. Obviously, it all depends on what SPY itself will do, because that's where, you know, my cloudy view is still very, very present. And I'm gonna finish this off with a quick look at the chart of SPY and see how that might impact what we just saw for technology and for healthcare. Wrapping this up with my charts for SPY, and this is the weekly version. And you know, those of you who've been watching these videos over time will recognize this chart. Didn't change a lot. As a matter of fact, I didn't change anything. And where last week it looked as if we were about to break and negate this negative divergence, but look at where we are now. And I'm fully aware that it is Thursday and we haven't even closed yet. It's still 30 minutes to the close. Market is down about 0.5% roughly. But that's not really the issue. I mean, it's the fact that this negative divergence is still intact, or, you know, if we remain here, unless we get a very strong close into the end of the week, so remaining part of today and tomorrow, we will still have that negative divergence in the RSI as well as in the MACD in play and confirmed with a new lower high. And a higher high in price, and price now resting at support offered by the previous resistance. Not the strongest combination of things, if you ask me. It's completely contradictory into what we just saw for seasonality, which is calling for a very strong month of October. But for me, in order to see that happening and to see that actually executing, we do need to negate this negative divergence. To me, that's the only way we can actually push really higher, because after the break 3 weeks ago, we did have a little bit of a move, but then we kind of stalled and we're now back to our breakout level. So we didn't get that acceleration higher that you would normally expect when you break resistance, when you really break resistance. If we move to the daily version of this chart, things got a little bit more granular and you see the same thing happening. The RSI is not confirming the recent highs. It's you know, putting this, it's not a, depends on how you look at it. I still call this a negative divergence because the RSI is at the same levels, whereas the price is higher. And you saw that happening here as well in June and July, where the peaks in the RSI are at the same level, but the peaks in the price were clearly higher. And you can see it happening right here, right now, despite the fact that RSI is not really above 70. This trend momentum indicator is not confirming those recent highs. And here you can see in a little bit more detail how it's resting for 2 days already at that previous resistance level, now acting as support. The area of support is, you can draw this line at a number of levels, but you know, probably safe to say that around 560, between 560 and 565 is where the support is. If that breaks, we break this horizontal level, but we also break this rising support line, which opens up the way for a decline towards roughly 540 as the first target. I've been playing around with this lower line here. First of all, it's only 2 touch points, so it's very debatable whether you want to call this a trend line or not. The top line is different. That's got 1, and then here's a number of touch, and then another one and another one. So this one's quite reliable. And if we put this one here and just assume that it is going to do something, and we see a touch point here, it could work out as being a rising wedge. And breaking out of a rising wedge is a negative thing. And if I combine that with the negative divergence on this daily chart and the negative divergence on this weekly chart, again, I find it hard to see a full-fledged and a very rapid acceleration in the rally and the S&P 500 based on this chart. What we need to have in order for the market to rally, for tech to really outperform, is a break of this negative divergence. If we can negate this, then things will start to look a lot better for the S&P 500. While we're still under pressure from this negative divergence, XLK can still outperform. That's absolutely possible. But the question is whether it will drag the market higher. And if XLK outperforms, we will have a number of other sectors underperforming. Again, so I'm sorry, but the picture remains unclear. That doesn't mean that there are no opportunities. There is always opportunities. There's individual stocks. You can play sector rotation plays. For this month, I would look at, probably long positions in tech and maybe some shorts in healthcare. That's what the rotation tells you. That's what the RRG tells you. That's what seasonality is telling you. And those can be, market agnostic, SPY agnostic trading opportunities. For the market as a whole, things remain slightly clouded. There's no clear definition of where we're going, no clear path of where we're going. We need a little bit more confirmation. And for me, that confirmation will either come from an upward break negating this negative divergence, or an execution of this negative divergence by a downward break, let's say below 560. I think that's enough of a confirmation to say that the market is going to go a little lower. And remind you, we did the long-term stuff last Monday on the monthly charts. We're still in a long-term uptrend. I'm just trying to figure out whether we need to rejoin the uptrend around current levels or whether we will get a better entry opportunity in the next few weeks. Thanks for watching, and I'm hoping to see you again next Monday, same time, same place.